Hey there, business buffs. Danny's here, ready to break down a financial metric that's more exciting than it sounds. Accounts receivable turnover. Think of it like this. You're running a lemonade stand because who isn't these days? You sell some refreshing lemonade on credit, trusting your thirsty customers to pay up later. Accounts receivable turnover tells you how quickly you're turning those IOUs into cold, hard cash. In the business world, cash is king. The faster you collect payments, the more cash you have on hand to reinvest in your business, pay your bills, and maybe even treat yourself to a celebratory vacation or two. So, buckle up, because we're about to dive deep into the world of accounts receivable turnover and learn how to make it work for you. Section 2. Cracking the code, the AR turnover formula. Alright, let's get down to business, pun intended. Calculating your accounts receivable turnover ratio is easier than you think. It's like making instant ramen, but instead of noodles, you're dealing with numbers. Here's the secret formula. Accounts receivable turnover ratio equals net credit sales divided by average accounts receivable. Don't worry, we'll break it down. Net credit sales. This is the revenue you generate from sales made on credit, minus any returns or discounts. Basically, it's the money people owe you for being awesome. Average accounts receivable. To get this, add your accounts receivable balance at the beginning of a period to the balance at the end of the period, and then divide by 2. It's like finding the average of your Netflix binge-watching hours, but instead of episodes, it's outstanding invoices. Once you have your ratio, you can convert it into days to see how long it takes on average to collect payments. Just divide 365 days by your ratio and voila, you've got your average collection period. Section 3. High ratio versus low ratio, tales of two businesses. Now that you know how to calculate your accounts receivable turnover ratio, let's talk about what it means. A high ratio generally indicates that you're a collection ninja, efficiently converting credit sales into cash. On the other hand, a low ratio suggests that you might need to work on your collection game, as it's taking longer than usual to get paid. Let's imagine two businesses. Speedy Gonzalez Services. This company boasts an impressive accounts receivable turnover ratio of 12, meaning they collect their receivables 12 times a year, or roughly every 30 days. They're like the Usain Bolt of cash collection, fast, efficient, and always ahead of the game. Slowpoke and Sons. This business, unfortunately, has a ratio of 4, indicating that they collect their receivables only 4 times a year, or every 90 days. They're like a sloth in the world of cash flow. Slow, steady, and sometimes a little too relaxed. While a high ratio is generally desirable, it's important to note that the ideal ratio varies depending on the industry, business size, and other factors. For example, a grocery store with mostly cash sales will naturally have a higher ratio than a manufacturing company with longer payment terms. Section 4. Why your AR turnover ratio is your business BFF. Your accounts receivable turnover ratio is like your business's best friend. It tells you the truth, even when you don't want to hear it. By keeping a close eye on this metric, you can track your cash flow. Knowing how quickly you're collecting payments helps you forecast future cash flow and make informed business decisions. Evaluate your credit policies. If your ratio is lower than desired, it might be time to review your credit policies and tighten the reins on late payments. Identify potential problems. A sudden drop in your ratio could be a red flag, signaling potential issues with collections or even customer financial troubles. Impress investors and lenders. A healthy accounts receivable turnover ratio demonstrates sound financial management, making you more attractive to potential investors and lenders. In short, your AR turnover ratio is a valuable tool that can help you make smarter business decisions, improve your financial health, and sleep better at night, knowing your cash flow is under control. Section 5. AR turnover ratio. Limitations. Don't be fooled. While the accounts receivable turnover ratio is a powerful metric, it's not without its limitations. Like that friend who gives great advice but occasionally forgets your birthday, the AR turnover ratio shouldn't be your only source of financial insight. Here's why. Industry variations. As mentioned earlier, the ideal ratio varies across industries. Don't compare your ratio to a company in a completely different field. It's like comparing apples and oranges, or should I say, lemonade and lawnmowers. Seasonality. Some businesses experience fluctuations in sales and collections throughout the year. A seasonal spike or dip in your ratio doesn't necessarily indicate a problem, as long as you factor in the natural ebb and flow of your business cycle. Other factors. The AR turnover ratio doesn't tell the whole story. It doesn't reveal specific customer risks, pinpoint your most valuable clients, or account for external economic factors that might impact collections. The key takeaway: use the AR turnover ratio as a starting point for analysis, but don't rely on it solely. Combine it with other financial metrics and qualitative insights to get a comprehensive view of your business's financial health. Section 6. Boost your AR turnover. Tips and tricks. Ready to become an AR turnover champion? Here are some practical tips to speed up your collections and boost your ratio. Invoice like a boss. Send invoices promptly and make sure they're clear, accurate, and easy to understand. No one likes deciphering a confusing invoice, not even your customers. Set clear payment terms. Clearly communicate your payment deadlines and consequences for late payments. Don't be afraid to be firm but fair. It's your money after all. Offer multiple payment options. Make it easy for customers to pay you by providing various payment methods, such as online payments, credit card processing, and even good old-fashioned checks, if you must. Automate, like it's 2025. Embrace technology and automate your invoicing and payment reminder processes. There are plenty of software solutions available that can save you time and headaches. Reward early birds. Consider offering early payment discounts to incentivize customers to pay on time. It's a win-win. They save money and you get paid faster. Remember, improving your AR turnover ratio is an ongoing process, not a one-time fix. Continuously evaluate your processes, experiment with different strategies, and don't be afraid to seek professional advice when needed. Section 7. AR turnover, your key to financial freedom. Congratulations! You've made it to the end of our AR turnover crash course. You're now equipped with the knowledge and tools to master this essential financial metric and unlock your business's true potential. Remember, a healthy AR turnover ratio is crucial for maintaining a strong cash flow, making informed decisions, and achieving your financial goals. So go forth, be proactive, and watch your business thrive. And always remember, as the great philosopher and comedian Hassan Minhaj once said, financial literacy is not a joke. It's the key to a brighter future, one invoice at a time.